Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us remotely is Ed Coughlin. He's Director of Trading Services over at Nasdaq with an overview of trading activity and some of the enhancements we are making to dampen volatility and protect investors. Ed, it's great to have you with us. Thanks so much for making the time. I know these are unprecedented markets. We're seeing volatility that's on a historic level. What are you hearing from desks? How are clients responding?
Well, I think I'm hoping this doesn't become the new normal, but clients are settling in. Most of, certainly Nasdaq's workforce is working from home. Most of the firms that we deal with, nearly all, if not all, of their staff is at home. And while there's been, kind of as you said, unprecedented volatility, I think firms are dealing with it quite well. We are still interacting with firms on a daily basis. Volatility is obviously at extreme levels. Volume, to put it in perspective, we're doing 2 to 3 times, normal average daily volume that was occurring before all of this happened. But I think it's really fair to say that the infrastructure and plumbing behind the markets has really performed well during this period. And it's kind of given confidence to both, investors that can participate in the market and liquidity providers for them to be able to step in and commit capital during these periods of time.
Let's talk about Nasdaq closing cross enhancements and the technology that you're putting into place to protect our investors.
Sure. So one of the things, this has been a great test of what we put in last fall. We've kind of changed the closing cross over the last couple of years to make it provide, what I would say, fair and equal access to all, to increase the transparency and flexibility in being able to participate in the cross. What we did last fall is we had heard from investors that they wanted more of an ability to interact with closing imbalances. And what we did is we changed the time period in which the imbalance information was disseminated and gave firms the flexibility to be able to enter market orders or unrestricted price limits to be able to trade in the close. And especially during this period of the last 6 weeks, firms have had the confidence to come in and to be able to respond to imbalance messages, offset liquidity demands when they're out there, or to be able to participate on either the buy or the sell side in the market. And we see firms having increased confidence in being able to trade in the close. In fact, close volumes are up anywhere from 50 to 100%, during that period. One of the things I take in running the desk itself is while I don't get calls from people saying, oh my gosh, fantastic job today, we're not getting calls of complaints. We are getting people that are encouraging us, that have, kind of applauded, all of the exchanges and their performance during this, heavy stress period.
And to wrap up here, what are ways that exchanges are working to help dampen the volatility?
So one of the things that's in place, Jill, and, it's kind of the work that's been done over the last 10 years after periods of volatility that occurred in the past. There's mechanisms by which we try to dampen volatility for individual stocks. The limit up, limit down plan was formed, where securities themselves, if there's a sudden price move in under a short period of time, the stock gets halted. And it gets halted for a period of 5 minutes, and then the stock is not allowed to reopen unless it's going to trade within 5% of where it last traded. And if the auction coming out of that opening is indicated to trade more than 5% away from where it last traded, the price protection or the auction collars will widen by 5% every 5 minutes. And what that does is, I like to think of it as it gives cooler heads a chance to come into the market. It allows humans to come into the market to see price action or indications of prices and to make a fair judge of where that security should be trading, so that you don't have a sudden price move and somebody then is able to look back and say, oh, if I wish I had known that stock was going to drop 5% or 10%, I would have gladly stepped in. But that's been highly received in the market. In fact, if we look at March, and while there was extreme downside volatility, there were often as many limit up halts as there were down halts. And then from an overall systems perspective, to kind of have a protection around the entire market, there's something called market-wide circuit breaker protections in place. Those rules have been worked on for a number of years, but it actually had never been put into place. Those rules set a protocol in which if the market were to drop 7% the market would halt for 15 minutes, again, giving investors a chance for cooler heads to prevail, to come in and to offset, selling pressure in the market, or if they saw indications that more attractive prices, they'd come in and buy stocks. We've had those market-wide circuit breakers trigger now 4 times in the last month. Those, for the most part, those market-wide circuit breaker halts have been effective in dampening volatility in the market, and it's given people the confidence that there's mechanism in place. They've been, tried and tested now, so that if in fact you get, sudden volatility to the downside, there's a mechanism to halt that for a moment, get everybody to kind of take a breath, look at the market, are these reasonable prices, and then encourage people to come in and participate in those auctions. And that's been quite effective.
All right, Ed, appreciate the update. Thanks so much for joining us on Trade Talks.
Oh, thanks for having me, Jill. Stay safe and stay well.
All right, and same to you, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.